Pensions and other post-employment benefits can be considered a lot of money that governments have to come up with through taxes and other revenues in order to provide the employees of said governments with those benefits. Pension plans are required to be reported in the basic fiduciary fund statements for the sponsoring government. Now again, keep in mind what's showing up in these fiduciary funds. These are basically items that are for the benefit of others. So if we were to just say looking at the assets of a pension trust fund included in the fiduciary funds, those assets are not assets of the government. They are basically for the benefit of the employees at their time of retirement. Now, if we consider how we also need to treat information regarding pension benefits from the viewpoint of the government's financial statements, we need to think about it at both the government-wide level and also at the fund level. So we've got the general fund, we've got all those other types of governmental funds, and then we've got proprietary funds. So at the fund level, we're going to show things like expenses or expenditures depending on the basis of accounting, and we're going to reflect some liability numbers. And then over here on these fiduciary funds, we've got to report info regarding what's in the plan. Okay, so the fiduciary funds are not the assets, so to speak, of the government. It's for the restricted purpose of providing benefits. So let's first take a look at pension trust funds and how the funds go about accounting for some things. And then we're going to take a step further and look at the employer's pension accounting. So what do we need to show as far as the pension trust fund? And then what do we need to show at the government-wide level or the fund level? Both of them. All right, so what we're talking about specifically in this chapter, in this particular segment, is really what's referred to as public pension plans. All right, so these are being provided to the employees of governments. GASB has standards regarding these. They used an accounting-based approach. We have an economic resources measurement focus for how they go about reporting the pension liabilities and expense, and a much broader perspective here than just what is the net pension position as contributions to date and progress toward funding, but a more robust way of handling all the things that we need to show from an accounting and reporting standpoint. Now we have what we call defined contribution plans, and we also have defined benefit plans. Defined contribution plans, we think of 401ks as a really prime example of a defined contribution plan. And with those types of contribution plans, the amount that is being contributed by the employer and even the employee can be very specific. It can be listed in a set dollar amount, or it can be a set percentage, and typically this is applied towards an employee's salary. And these are contributed into a fund or a plan, and the amount that will later be available for payout when the employee who is the recipient or the beneficiary of this is able to pull it out is totally susceptible to the earnings and growth on those contributions. So if you think about it, the benefits are not defined. Just the initial contribution is what is defined. So the risk of the employee not having enough to live on later in retirement due to what happens in the stock market and inflation, et cetera, is totally resting with the retiree, not with the entity who employs the people, but with the people that are going to be pulling out funds later upon retirement. Reporting for these defined contribution plans is not too complicated. Basically, the employer is going to keep up with their contributions, and they're going to be reporting them as expenditures or expenses based on the type of accounting basis that they use. And of course, they would accrue any liability necessary for reporting if they've got some contributions that haven't been paid out yet that need to be paid. There are standards for the accounting and reporting for defined contribution plans. And of course, there are requirements for disclosures. Regarding the scope of this particular section of this chapter, I really am not going to be testing on actual journal entries. I more or less want you to focus on the terminology and consider how it's going to be reported from the viewpoint of the pension trust funds and how it will be reported at the fund level and the government-wide level. So think about that as we proceed forward with the discussion here. Moving on and looking at the other possibility for pensions, we have the defined benefit plan. And this is where it gets very complex. With a defined benefit plan, the government and even companies have made promises specifically defining how they are going to pay out the recipients or the beneficiaries or the retirees, whatever you want to call them, later. It's based on a formula typically. Now, many companies used to offer defined benefit plans, but due to some of the things like what we're going to be discussing next in this segment, have instead had these companies convert themselves from offering defined benefit plans to instead offering defined contribution plans. With the defined benefit plan, the big issue is not only is the accounting and reporting and calculating super complex, but the risk of the fund needing to be able to provide those payouts at a later date actually rests with the employer now. So if they've made a promise to fund someone's pension payments at a set rate or set amount later in the employee's life, then they've got to find a way to fund it. All right? So, if you'll think about it, if we're talking about government promised defined benefit plans, what we're really talking about is the government defining how the taxpayers are going to have to come up with the money via taxes and other revenues in order to fund said promised or defined benefit plan pensions. Many governments sponsor several employer pension plans. For example, they may set them up differently based on the classes of employees. Also, in some states, some or all of the local governments within that state may actually be participants in a statewide defined benefit pension plan. If you have one of those, it's referred to as a public employee retirement system. Acronym for that is PERS. With these defined benefit plans, again, it's exceptionally complex. Actuarial scientists have to become involved heavily in calculating information that has to be accounted for but also disclosed. The things that have to be shown within the fiduciary fund financial statements and or of actual plans is quite extensive. As you can imagine, when you've got millions or if not billions in play here. With the actuarials, they use very complicated formulas to help calculate what will result in a present value amount for the projected pension benefits that were promised to the employees. Things that they're going to consider: length of life, so employee mortality. They'll also consider data regarding employee turnover, because many times the length of service that an employee participates at a company can affect the amount that needs to be funded. Again, these formulas have all kinds of variables. They will also consider salary levels and salary progression, even including such things as investment earnings, rates of inflation, interest rates, and all kinds of other things in order to come up with numbers that have to be utilized in the accounting and reporting. When they do this, they are also going to use a lot of assumptions. And over time, assumptions can change. So it is quite frequently necessary for recalculations and revisions to be made. One of the things that they're going to be doing is calculating the present value of the projected pension benefit liabilities, and they will also calculate, based on their methods, the dollar amount required for contributions from the employer standpoint and even from the employee standpoint when applicable, that will be needed in order to fulfill the obligation at the later date, that promised pension amount. So again, we've got the present value of the total pension liability, but then also they'll even help to calculate what needs to be contributed in order to make that be available later. In regards to the types of pension plans discussed, we can have a single employer pension plan, and that's basically where one employer and its employees only are inside the plan. Or we can have a multiple employer pension plan, and that's where we've got more than one participating employer and all of their combined employees within a plan. These multiple employer pension plans can either be an agent multi-employer pension plan or a cost sharing multi-employer pension plan. The agent version is basically where they're pooling the investments for investing purposes, but they're keeping up with everyone's information, each employer's information and their employees separately from the other employers and employees. All right, so it's separately accounted for. With the cost sharing multi-employer, the investments are being pooled and the assets of all of the employers, that are there for the benefit of the employees can be used to pay the benefits promised to any employees of the differing employers. Something to think about. With GASB and financial reporting of these defined benefit pension plans, they do have a setup framework. There are required financial statements. There are plenty of note disclosures necessary. And instead of me rattling those off here in the video, I do recommend that you take a look at the list and consider how much details got to go in to gathering all of this information and disclosing it within the funds, the fiduciary fund reports, and then the applicable government-wide information that would also be necessary. So there's quite a couple of entries within the text about the disclosures, including required supplementary information that must definitely be part of the reports. Let's talk for a minute, though, about the financial statements. If you would, you could even pause the video and go and locate the statement of fiduciary net position and also a statement of changes in fiduciary net position. And then we'll talk about a couple of things on there. So if you would, pause the video and then locate an illustration. All right, looking first at the statement of fiduciary net position, you can see that we have assets, liabilities, and net position restricted for pensions. Again, think about what we're doing here. This is a report that is going to be provided showing the fiduciary position. This is not the government's actual assets, liabilities, etc. This is really for the benefit of the people who have been promised the benefits. All right, so think about that. We're showing the cash, any interest receivable, investments at their fair value, any holdings in bonds, common stock, commercial paper, repurchase agreements, and other types of investments that they may actually be holding within the plan, all as of the date of the statement. So what was their value on these dates? And then minusing the liabilities of the particular plan. Are there any accounts payable, any type of accrued expenses that need to be showing up here? And normally these should be very small in comparison to what's being held within the plan. And then if you subtract the liabilities from the assets, what you are showing is the net position of the plan as of that specific date that has been restricted for the payout of the pensions that have been promised. Consider also some things that could show up in this liabilities area. What if there are some benefits that are due but they haven't been paid as of the date of this statement? Those would be showing up as a liability. Are there any refunds that need to be paid out to terminated employees? For example, what if the amounts within this plan, part of them are employee contributed, and if the employee terminates either voluntarily or involuntarily prior to retirement, we may have to refund them what they contributed. So if we owe somebody that, it would show up as a liability as of this particular date if it hasn't been paid out. Any payroll taxes could show up as a liability there. All right, so net position restricted for pensions. Now, this is a number we're going to need not just on the next financial statement, but also on another statement that we're going to utilize to help us calculate what the government-wide statements need to show as the liability of the government. All right, so keep that in mind. Looking now at the statement of changes in fiduciary net position. Notice we've got the additions and then we've got deductions. Additions are going to be for contributions put in during the period by the employer, any contributions contributed by employees, if any, during the period, any investment income. We could show a net increase in the fair value of investments. And again, it's the net increase, so if it increased, by how much. And we could show interest and dividends received on the investments. If you add all those up, that would be your total additions. In regards to deductions, in other words, it's basically the outflows from the plan during the period. Any annuity benefits that were paid out, any disability benefits that were paid out. These plans can have all kinds of things within them based on promises made to the employees. If we have refunded any terminated employees, for example, they're not vested yet, but if they've contributed their own, we may have to, again, write them a check and give them their money. So deductions would be for that. Any administrative expenses would also be deducted. And then we could calculate the net decrease. All right, so hopefully the additions are going to be much larger than the deductions, and we should have a net increase in net position. In a way, this bottom part of this form kind of works like a statement of cash flows. There's our net increase in net position. If we take that number and add it to what the prior period showed as net position restricted for pensions on the statement of fiduciary net position from the prior period, and add that to it, we should get net position restricted for pensions end of year, and that number should tie out to the net position restricted for pensions on the statement of fiduciary net position. In regards to reporting and the scope of our work in this class, I really want you to just get the overview regarding these pension trust funds. I want you to focus on just the basics and the terminology within the chapter. Again, keep in mind, we've got one viewpoint of what do we have to do at the fiduciary fund reporting level. Again, we've got these required financial statements. We've got lots of notes. We've got additional required supplementary information. And I do want you to take a look at the schedule of changes in the county's net position, liability, and related ratios. So again, it's called the schedule of changes in the net position, liability, and related ratios. So whichever example you happen to have in your text, depending on which version you're looking at, I want you to focus very selectively on a couple of things. Look for the term total pension liability ending and circle it. This dollar amount is the present value of the projected benefits to be paid by the plan that are attributed to past services of the employees. So in other words, they've earned it up to the date that these financial statements have been put together. Now, this was calculated based on our actuarial sciences, folks, but this is typically a pretty large number. And then I want you to scroll down the form a little bit, and I want you to look at another number. The plan fiduciary net position ending. Circle that. Where's that number coming from? The plan fiduciary net position ending is equal to our balance on our statement of fiduciary net position. In other words, this is what we currently hold in trust, and what we need to do is compare that number to that total pension liability and find out where we stand. So if you subtract the plan fiduciary net position ending from the total pension liability ending, what you get is net pension liability ending. This is a pretty large number. This is the amount that needs to show up as a liability for the government. You can also see that below it, they have it as a ratio. So in other words, they took the plan fiduciary net position and divided it by the total pension liability. And basically they're saying it is X% funded thus far. Think about what's going on there. Also, one thing to look at and understand is the term service cost that is showing up on this same report. And service cost basically is the actuarial present value of projected benefit payments that are attributed to the current year's service of the employees. That, to me, is another pretty good term that you should know. Regarding what the employer government has to do with this information, again, we're talking about pension accounting, and from the employer's viewpoint, the pension-related expenses or expenditures, depending on the type of basis of accounting that the particular area or entity, if you will, the fund, whether it's a governmental fund or proprietary fund, whichever terms they're supposed to be using to show the items within their financial statements, we would do that. We would even show applicable liabilities, any deferred inflows or outflows as necessary. Consider how we've seen these expenditures and expenses of the different types of funds and general government, how we've been recording and reporting them all along up until now. Think about the fact that these employees who have been promised these benefits have worked for us during the period and have earned these rights to these promised pension payments. So we're going to show these expenses and expenditures as we're moving along, and then making sure that we follow the standards and guidance applicable as provided by GASB. They've got certain things we have to do regarding measurement, how we recognize them, and how we report it. So pension expense or pension expenditure is what we're talking about. And again, the net pension liability is an important number. So basically, it's that total pension liability minus the fiduciary fund's net position in that pension trust fund equals the net pension liability, the number that needs to be shown. The net pension liability represents the unfunded pension liability. This unfunded, as of the statement date, amount is to be reported on the government-wide statement of net position. So the government as a whole needs to show this massive number because it is an obligation. It is still a liability because it has not been funded yet. Now, GASB requires the pension expenditures or expenses to be recognized, and there are some calculations in the text regarding how this is done. But again, scope issue, I'm not going to worry about that, but I just want you to understand that we would be recognizing at the fund level and at the government-wide level expenditures and expenses, and also at the government-wide level, definitely showing the unfunded pension liability amount. Couple of other items that are also of mention in this text is OPEB, or other post-employment benefits, and also termination benefits, things that are still of concern to governments due to their liabilities and or expenses of them. So other post-employment benefits, we're talking about things other than pension plans, and typically it's some type of promise to the employees regarding their health care insurance that will be provided later, their life insurance benefits that will be provided to them or their family later, even long-term care insurance or benefits that will be provided to them later. And long-term care is a very big issue regarding future escalations of health care cost and cost of, post-retirement, if you will, living, especially with the massive amount of folks that are in that baby boomer, etc. generations. GASB has accounting and reporting for OPEBs. It's quite similar to what we have discussed and seen in regards to defined benefit pension plans. There are some examples within the text regarding how the journal entries look to record the additions and deductions and things like that, and the payouts. And then with termination benefits, what we're talking about here is how do we treat any benefit that was offered and given to employees based on the type of offer we made them and the type of termination. So voluntary term benefits are those such as maybe some type of incentive check paid to get employees to voluntarily quit or retire early. And then involuntary term benefits are basically we are terminating employees early for some specific reason. Maybe we're having to cut back on the number of employees we have due to economic issues, and maybe in order to ease that over for them and at least help them transition to finding hopefully another job soon, maybe we give them a severance check of some sort, and or offer some type of career counseling or career training. So GASB has information in their standards of how governments also deal with those kinds of things.